Welcome back, students who are taking financial accounting, and we left off in the last video with problem 3-11 from the assigned homework problems for chapter 3 of the short exercises. So we'll pick up where we left off with 3-12 here, and so we only have 2 more left to do, and hopefully it'll be just this one video and not 2. We'll see. Right, and again, if you don't understand something, rewatch the video or contact an instructor. All right, so adjusting and closing entries. For the following series of journal entries, indicate whether each is an adjusting entry or a closing entry. Right. Well, this is relatively easy to do in that if, when you make adjusting entries, you're not closing out to retained earnings, okay? Closing entries, you're closing out to retained earnings. So when you're looking at an entry, if it has retained earnings in it, that means it's a closing entry. If it doesn't, that's an adjusting entry. So for this first one here, this is an adjusting entry, all right? Because there is no retained earnings account. You're not using the retained earnings account. For the second one, you're using retained earnings here, so that's a closing entry. For this third one, retained earnings, it's a closing entry. And this one doesn't have retained earnings, so that's adjusting entry. And it's just that simple, okay? I mean, the problem gave 5 to 10 minutes in order to do this one, and I did that in less than a minute, okay? Just because I know from the concept that when I make closing entries, I'm closing out to retained earnings. Okay, but it's not to say, I have to be, warn you here. It doesn't necessarily mean that I can't make an adjusting entry to retained earnings. Okay, it is possible for that to happen, but with this level of accounting and the way we're thinking about it right now, all we're trying to do is just determine whether you understand the difference between adjusting and a closing entries, okay? Not to be adjusting a retained earnings account, all right? It is possible to have to adjust a retained earnings account because of an error that was made. And then, you would be looking at that transaction, and you'd also be looking at the description to see why you're, what you're doing with the retained earnings account in order to determine that it is an adjusting entry versus a closing entry. But for this purpose, simple as closing entries are made to retain earnings. So no, yes, yes, no. Okay. All right. Last problem. Okay. After closing its accounts at July 31st, Anderson Realty had the following account balances. So with these account balances, and it's telling after closing, so that's post closing. And since these are ledger accounts and the balances in the accounts, this is in a post-closing trial balance. It says here, prepare Anderson Realty's post-closing trial balance. List the accounts in the proper order. So that's all I'm doing is just rearranging this information, okay? All right, so let me go about it here. And again, formatting wise, I'm going to be very general here because I'm just working on this one slide, right? So, follow the example in the solution. I'm going to, I'm not paying attention to capitalization. I'm going to abbreviate. You don't do those things when you're creating one for somebody else to see, okay? But here, I'm going to take some liberties with my formatting, like I just put post-closing and T/B for trial balance. I'd actually write out the word trial balance. And the date was July 31st, so 7/31/2014. You'd write out the date. Remember, this date is, this heading is center aligned, okay? And we could have our accounts numbers here, Okay, since we weren't provided them, we don't need that as a column, but if you're actually doing it, I highly recommend that you do it because you'll have a chart of accounts, and then you'll list your accounts, and of course that would be written out, and I'd have a debit column and I'd have a credit column. So now I'm going to list all of the accounts, and I'm going to list them in the the correct order by categories of accounts, and if they were listed as account numbers, that would be great. So I have cash, I have accounts receivable, and I had prepaid insurance, and I had, let's see here, I've got cash, receivables, prepaid insurance, a prepaid rent account. So prepaid, and again, I'm just abbreviating here, all right? You would write out everything and make sure you're using capitalization. After prepaid rent, what other asset accounts do I have? I have an equipment account here. So put my equipment here. And I'm abbreviating that. Go up. Any other asset accounts? Yes, because I have an accumulated depreciation. That's the contra account. Notice it says accumulated depreciation equipment. So underneath equipment, I would have accumulated, and I'm abbreviating here, of course. Okay, so those are all my asset accounts. So now let's look at liabilities. I have an accounts payable and a notes payable. Accounts payable comes first, then notes payable, because of liquidity, right? Meaning accounts payable is in, you're going to pay that in 30 days, whereas a notes payable is, it's longer than a 30-day. I mean, you can have a note payable of 30 days, but generally it's for a longer term. And since accounts payable, generally the terms of accounts payable are 30 days or less. The accounts payable comes before notes payable because of the amount of time it takes to pay the liability. Remember, with assets, you're looking at liquidity when they're listed on your chart of accounts, meaning, how quickly can something be turned into cash? Okay, since cash is already cash, it's right at the top. Your accounts receivable would be next, right? Because you expect your customers to pay within 30 days. Your prepaid insurance and prepaid rent, well, you gave that money to somebody else for an extended period of time, and of course, to sell the equipment, it takes a lot longer to sell equipment than it would be to get back an accounts receivable. So they're kind of listed in that order. But when it comes to your liabilities, it's listed in like a time sequence on the amount of time owed, right? The longer time owed versus the shorter time owed. Okay, accounts payable is very short, whereas notes payable, it's kind of long. And then mortgage payable would be next, or a long-term note would be next. It all depends upon what you have, but they get listed in order of time. Okay, for equity, we have common stock and retained earnings, and I don't have a dividend account, so common stock and then retained earnings. And what else do we have here? Okay, so we have, since this is a post-closing trial balance, right? Notice that for service revenue, we have 0, and for our salary expense, we have 0, because what? We closed those accounts out. And on your post-closing trial balance, you can list your revenue and your expense accounts, and they only have 2 here, one revenue and one expense, and that's fine if you listed them, but realize that if you had, say, 1 revenue and 10 expense accounts, all they would just have is zero balances. So on the post-closing trial balance, since we know that we've made the closing entries and that those temporary accounts have zero balances, it's acceptable not to list them on the post-closing trial balance. Now, if this obviously was an unadjusted trial balance or an adjusted trial balance, our revenue and expense accounts would have balances, so they would get listed on the trial balance. But because this is post-closing and those accounts are zero, we don't have to, we don't necessarily have to list them on the post-closing trial balance. And of course, now that we have the accounts listed in the order, we're going to have a total, okay? And we now go back up and we start taking all of these figures for those accounts and we list them. So cash had 3,800, and since it's the first number in the column, we put a $sign. Receivables was 2,300. Prepaid insurance was 4,200. Prepaid rent was 1,600. Equipment was 45,500 as a debit. Now, accumulated depreciation, okay, it's equipment is 45,500 and accumulated depreciation is 4,600. But remember, accumulated depreciation is a contra account to the asset account, all right? So, since this is equipment and it's the contra account to it, it's going to have a credit balance, not a debit balance. And of course, since it's the first number in that column, we put a $sign there. So whenever you see on your trial balance, an asset and then accumulated depreciation, know that the asset is going to have generally be a debit, and the accumulated depreciation is going to be a credit, and it goes in a different column. And the difference between the two is the book value, okay? So the book value being 45,500 less the 4,600, which is $40,900 is the book value of the equipment, okay? 45,500 less the 4,600. Right, so accounts payable was 2,100. Notes payable was 5,000. Common stock was 35,000. And our retained earnings was 10,700. Okay, so we draw a line, do the math. Since it's a final number, it gets a double underline, and that's 57,400. We put the $sign because it's a dollar, not a decimal. Same here. When we do the math, don't just automatically copy, don't just do the math here for your debits, all right, and then take that number and copy it over here for your credits. You don't want to do that. The reason why is because what if you made a mistake? What if you had written 2,000 here, okay, instead of 2,100, okay? You do the math here, and you no longer come out with 57,400, you come out with 57,300, okay? So, debits have to equal credits, so do the math for each one so that you can make, you're correct, right? This should be 2,100. And when I do the math here, then write in the 57,400. Again, don't just automatically assume that whatever you had for a debit, automatically becomes a credit and you stick it in there. That's called fudging the books. And you're not, the whole idea behind double entry bookkeeping is to be able to make sure that you're accurate and that you're catching your mistakes. If you're not following the processes, you're not going to catch your mistakes, and you end up what's called fudging the books. And the legalities of that are, if it stays within a company, like if I'm a manager or an accountant for a company and I'm doing this and I'm making these mistakes, well, I'm going to get fired because I don't have accurate information. If I take that information and take it outside of the company and give it to, a banker or an investor, something like that, to any third party for whatever reason, then I open myself up, the company opens itself up to legal issues because those businesses are making decisions upon inaccurate information. Okay, so there's a reason why you do what you do, and a lot of it has to do with keeping things accurate. Doesn't mean that you can't make a mistake. I mean, if I had, and I've talked about this in, theory videos, especially in making the, how to make a journal entry when you don't know how, yeah, you can make a mistake in recording, okay? But your debits have to equal your credits. You have to do the math to make sure that, whatever your number for your debit is, you do the math for the credits to see if they're the same, right? So that's that, and I'm not going to beat that horse anymore. And now we're done with the short exercises, so I'll see you in the next set of videos for the regular exercises for Group B. Okay.